and welcome to the Genuine Learning Blog. My name is Melissa Galasso, and today we're going to talk about more PPP accounting. So last week on the blog, we talked about governmental entities and GASB's proposed technical bulletin regarding the CARES Act accounting. This week, we're going to talk about a TQA that the AICPA has issued for non-governmental entities on PPP accounting. So this TQA, which is going to be in Q&A section 3200, long-term debt, addresses the accounting for PPP loans. Now, the question that was raised, how should a non-governmental entity account for a forgivable loan received under the Small Business Administration Paycheck Protection Program, or PPP? And basically what they came back with and discussed was the fact that legal form, this is a loan. You are supposed to pay it back. However, it can be forgiven. And so as a result, many people feel that in substance, while it is a legal document that is a loan, it can be a government grant. And the SEC has come out and said that they would not object to entities using either Topic 470, which is debt, or making an analogy to IAS 20, which is the International Standards, or IFRS, for government assistance. Unfortunately, the FASB does not have direct information in the codification addressing government assistance. Government assistance has been on the research agenda and on the technical agenda for some time for the FASB, but there is no existing standard at this point. As a result, we don't have direct guidance on how to handle this. And so the standard provides 4 different methodologies. The first one is debt accounting. Obviously, it starts out as debt. It's a loan. So you would put it on the books as a loan until the loan is either in part or wholly forgiven, right? So once you are legally released, once it becomes legally released, then you are no longer on the hook, or you pay it back, right? So if you don't get forgiveness and you pay it back, and then the loan would come off the books. Once the loan is forgiven, either wholly or in part, then it would reduce the liability and it would recognize a gain on extinguishment. So notice it would be a gain, not revenue under the debt accounting. IAS, which is the IFRS version of grant accounting, so IAS 20, uses this concept of recognition based on the concept of reasonable assurance, which is the GAAP equivalent of what we would call probable. And so government assistance would not be recognized until the conditions attached to that assistance will be met and the assistance will be received. So we have to have reasonable assurance that the conditions attached will be met and the assistance will be received. Once it is, what's going to happen is you're going to earn it on a systematic and rational basis over the period in which the entity recognizes as expense the related costs for which the grants are intended to compensate. So this is more like the matching principle. They would recognize upon the receipt of the cash the equivalent of a deferred income liability, and then they would slowly recognize into earnings as they are spending the cash. So you would actually have a portion released over a period of time if you analogize IAS 20. So you can see here timing is a little bit different, as well as the presentation. This could either be presented as a credit on the income statement under some type of other income, or it can actually be a reduction to the related expenses. So for example, if it was payroll, you can offset it. So a slightly different presentation option here. The other alternatives mentioned in the TQA that were not explicitly specified by the SEC, but are options for non-governmental entities, would be to analogize ASU 2018-08. So ASU 2018-08 is on target for this type of item because the relief of or the forgiveness of a loan is going to be a contribution under guidance. So if you look at the definition of a contribution, it's the receipt of an asset or the release from debt. And so in that scenario, it would be a contribution. However, there are measurable performance-related barriers under ASU 2018-08 you have to achieve. And so it would be a conditional contribution. So in that scenario, you would record it as a refundable advance subject to the ASU 2018-08. And then once the conditions have been substantially met or explicitly waived, then you would recognize it as contribution revenue. This is the accounting we would use for not-for-profit entities. And then the last option that they mention in the TQA is a gain contingency. This one's a little bit different here in that you would look at when it's realized or realizable, and then you would recognize it. So you'd initially, again, it always starts as a liability. It has to be on the books as a liability until at that point they determine that the proceeds are realized or realizable, at which point we would recognize it into the income statement. So this is pretty consistent with what the CPEA, the Center for Plain English Accounting, had already put out there regarding the accounting for these. And again, as we don't have on-point guidance, entities are going to have to decide what makes the most sense. What is the likelihood of having this be forgiven, and have to consider what would be most appropriate presentation for this. So the TQA does answer some questions in a, again, non-authoritative format, but provides a little bit of guidance and some really nice notices in the codification that you can go and take a look at. So hopefully if you have these PPP loans and you're looking at how to treat the forgiveness, this new TQA is there to help you. So thank you so much for joining me on the Genuine Learning blog, and I hope to see you on a future blog. Have a great day, guys. Bye-bye.